take a look at an example. So we purchase inventory for $5,000 on account. What does that mean, right? So let's break this down. So we're purchasing inventory. So we're saying that we now have inventory. We now have this right to this inventory that we're going to resell for a markup. So this $5,000 is the cost of it. And this on account is crucial, right? So we're purchasing inventory, but we're not paying with cash, right? We are going to pay whoever we purchased the inventory from. We're going to pay them back within some stated time period, maybe 30 days, whatever they work out in the contract. And you have to think about, this is how companies do business, right? Businesses don't require cash to be paid for these kinds of transactions immediately because it's costly, it's time consuming, but also the parties just want to, the seller just wants to push the sale out the door, and the purchaser wants to bring this inventory in that they can, then push their own sale out the door. And companies run credit checks on other companies to make sure that they will be able to pay them back. If you think about Macy's doing business with Nike, Nike doesn't need Macy's money right away. Macy's is going to have some accounts payable to Nike for any merchandise that they buy from Nike. Account is increasing, which is decreasing. So in this scenario, accounts are increasing. Where we now have an asset of inventory, which is going up. We need to raise that balance on our balance sheet by $5,000. We also now have this obligation of $5,000 of accounts payable that we will pay back in some future time. So if you're thinking back to the assets equals liabilities plus equity equation, assets are going up by 5,000, liabilities are also going up. So it balances on either side of the equal sign. So let's take a look at some additional journals. Let's say Apple purchases new equipment for $2,000. It'll depreciate at $50 per month. But the initial acquisition of the equipment for $2,000, right? It's not an expense because what are they buying? It's equipment. Or equipment is part of property, plant, and equipment. That section of the balance sheet, and it's an asset, right? So we're going to increase our asset by $2,000 for the cost of the equipment, and we're paying cash here. So our assets are going up by $2,000 and also down by $2,000 because we're paying cash. So that's to zero. Say Apple receives $10,000 cash in advance. Sorry, not in advance. That's later. Apple receives $10,000 in cash for services it performs. So we perform these services. We've earned, by performing the service, we've earned this revenue, whatever the services are. So we can credit our revenue, where we increase revenue with a credit. The normal balance of revenues are credits, right? The main, remember the big five, and we're receiving this cash. So we now have cash. Usually cash is going to be the easiest one to figure out. It's more clear often when you are paying or receiving cash in transactions. Third one, we hire employees, add them to payroll, no entry, right? That's non-transaction. So what if Apple pays $250 in dividends? So now remember, normal balance of dividends is a debit. And if you remember that dividends are paid out of our retained earnings balance, which have a credit normal balance. So if they're being paid out of retained earnings, right, they're decreasing from retained earnings, right? Then it makes sense that we would debit this dividend, which is going to decrease from the credit balance of retained earnings that we have. And we're just going to credit cash because companies are usually paying cash with dividends. So our cash is going down by $250, and our equity, right, overall total stockholders' equity is going down because retained earnings is going down by debiting a dividend. Some more journals. So Apple pays $2,400 for 12 months worth of insurance. So this is a prepayment, right? Because we're paying for 12 months worth of insurance. So we're going to use up over the next 12 months. We're going to receive benefits from this insurance over the next 12 months. But at the time that we purchase it, we're going to increase this prepaid insurance asset, which will be decreased each period that we use up the benefit of having insurance. So we're increasing our prepaid insurance asset, and we're decreasing cash because prepayments require that you are paying cash now. So kind of similar to this January 1st, or assets going up by one amount and decreasing by the same. On October 31st, Apple sold $5,000 worth of iPhones on account. So it doesn't matter that Apple has, it doesn't matter that they haven't received the cash yet. They've probably sold to a trustworthy customer, and they're fairly certain that they're going to receive this $5,000, so they can go ahead and increase accounts receivable and asset with a debit and credit sales revenue, because revenue goes up with the credit. So that balances. Apple receives a $500 cash advance from the customer. So our cash is going up, clearly. But because this is a cash advance, it's an advance of us performing a service, we haven't earned this cash, right? We haven't earned this revenue. So we consider it to be unearned revenue, right? If Apple doesn't perform these services, then they're going to have to give the cash back, right? So what if Apple issues 5,000 shares in exchange for $20,000? So they've sold a piece of their company, right? Sold a portion of ownership. They're receiving cash, right? Companies issue stock as part of, this is called equity financing. They are financing their operations, right? Raising money, by selling equity, right? Shares. So it makes sense that they're going to receive cash, in exchange for, some investor to have a portion of the Apple company. We're hitting on the T counts now. So T counts are really just the lazy person's version of a general ledger. So similarly for, in the general journal, historically the accountant's going to go and, make a entry on the general journal piece of paper and then file in the filing cabinet. The general ledger houses basically all of the, different transactions, all the different balances or the effects of each transaction to give you your current balance. So, there might be some description next to, each item in the general ledger that corresponds to cash, why we increased cash by $200, why we decreased cash by $100, why we increased cash again by $300, right? All to bring us to this debit balance of cash of $300. So that brings us to the end of the presentation. Scan this barcode, let us know how we're doing, what you thought of the presentation. All feedback that you have is greatly appreciated. And I hope you learned something. Thank you.